Equity financing and debt financing are two main ways companies raise money to fund operations, expansion, or new projects. The key difference is whether the company sells ownership, equity, or borrows money, debt, to raise capital. What is equity financing? Equity financing is when a company raises money by selling shares, ownership, to investors. In return, investors receive a stake in the company and may earn profits through dividends or share price growth. Example: a startup needs $1 million for expansion. It offers investors a 20% ownership stake in exchange for the funds. Investors make money when the company grows and its value increases. Pros of equity financing: no debt or loan repayments, lower financial risk, especially for startups. Investors may bring expertise and connections. Cons of equity financing: owners give up a share of ownership and control. Profits must be shared with investors. What is debt financing? Debt financing is when a company borrows money, such as loans, bonds, or credit lines, and agrees to repay it with interest over time. Unlike equity financing, the company keeps full ownership. Example: a company takes a $1 million loan from a bank with a 5% interest rate and must repay it over 5 years. Pros of debt financing: business owners keep full control of the company. Loan payments are predictable and can be planned. Interest payments are often tax deductible. Cons of debt financing: loans must be repaid with interest. High debt can increase financial risk. Key differences between equity and debt financing. Ownership: equity financing gives investors a stake in the company. Debt financing keeps ownership intact, but adds repayment obligations. Repayment: debt financing requires repayment with interest. Equity financing does not require repayment, but investors share in profits. Risk level: equity financing has lower financial risk, but results in ownership dilution. Debt financing has higher risk, especially if revenue is unstable. When to use each type of financing. Equity financing is best for startups or companies without steady cash flow. Businesses looking for strategic investors. Debt financing is best for companies with stable revenue that can afford loan payments. Businesses that want to maintain full ownership. Example of equity versus debt in action. A small business needs $500,000 to expand. If it sells shares to investors, it uses equity financing and shares ownership. If it takes out a loan, it uses debt financing and must repay the amount with interest. The choice depends on the company's growth potential, cash flow, and risk tolerance. Quick recap. What is equity financing? Raising money by selling ownership in the company. What is debt financing? Borrowing money that must be repaid with interest. Which is better? It depends on business goals. Equity financing is best for startups, while debt financing suits companies with steady income. Understanding equity versus debt financing helps businesses choose the right strategy to fund growth while managing risks and maintaining control.